And in our own forecast, we have expectations that there's going to be a surge in activity, consumer spending, and potentially hiring towards mid-year, the second half of this year, also associated with many people having access to the vaccine and potentially also taking the vaccine, which is a key element. And then also adding in the potential for some elements of the $1.9 trillion stimulus, or rather fiscal support package that the current administration is talking about. So certainly if we see growth expectations rise and also labor markets responding to that, then potentially the Fed might have to become a little less dovish, maybe slightly hawkish. But again, Powell mentioned that even if the Fed sees some minor increases in inflation, or even in pockets of areas of, certainly with respect to tourism or travel or certain types of services, that the Fed is not going to jump on that and see that as a reason to necessarily lighten up on the pedal of fiscal accommodation, but certainly would see those things as transient. And so I think, again, the big issue is getting those 9 million people back to work. And certainly, fiscal stimulus may not necessarily get us there, but certainly the vaccine rollout and having accessibility to the vaccine could get us there.
Paul, can you just explain to people how, and this is really what Powell's key message was, how keeping up their current super aggressive, easy policies are helping the economy achieve his goals? How does buying $120 billion worth of assets every month help the 9 million Americans, he said, that need to get back to work?
I think there are two things going on. Number one, in and of itself, accommodative monetary policy creates an atmosphere of growth. But more particularly, and I think this is the really key point, is that super accommodative monetary policy provides an invitation to the fiscal authority to go big, to go as big as possible. So I think the benefit of the super easy monetary policy is just not the direct channel, but effectively enabling, accommodating, and encouraging the fiscal channel to do what it needs to do. So we should look at this as a combo of monetary and fiscal policy that is going to get us back to the promised land of full employment. So I would not look at it in a narrow sense, but a broad sense, Sarah.
David, despite the Fed chair deciding that his policy doesn't influence market levels earlier in the press conference, I think we all know that last March, had he not acted, we could have seen a more profound sell-off and a less swift rebound than we did see. If we get another big sell-off in the next couple of months, no one's saying that we will, but were we to do so, is there less he could do this time round, or nothing he could do this time round to prevent it proliferating?
Absolutely not. Well, I mean, these guys have more ammunition than virtually any other central bank out there. If you look at the size of the balance sheet, the Federal Reserve's percentage of the economy, it's still one of the lowest in the G7 at about 35 or 36% of GDP. In Europe, the ECB's balance sheet is 65% of GDP. In Switzerland, it's 100%. In Japan, it's 130%. In the UK, I think it just broke 40%. We have a pretty small balance sheet as a percentage of GDP. So we could go a lot bigger than 120 a month. We could bring back the corporate bond facilities. Janet Yellen would certainly sign off on that. Dig deeper into the municipal side, which I think, there's probably some tweaks to make that a little better the next time around, just like any facility that comes quickly, you can learn a little bit about it. So I think they have a lot of ways to get involved with distributing stimulus more evenly, more fairly, more robustly across the economy, not getting caught up in the banks, and really reacting quite strongly to any problems with vaccine rollout or resurgences and strains that can't be tackled by the vaccine. So the backstop is fully there. I don't see anything he said or anything structurally that makes me think any different.
Shepard Smith here. Thanks for watching CNBC on YouTube.